Welcome back to this week's market update. Today is Monday, October 28th, 2024, and with that, we will jump right in. Looking at last week's weekly performance, stocks got a slower, predominantly negative week as markets prepare for two extremely busy weeks of upcoming economic data, a US presidential election, a Federal Reserve meeting, and much, much more. As of Friday, October 25th, the Nasdaq was one of the few major indexes to post a gain, up just 0.16% in the week, with the S&P 500 down just almost 8% as well, the Barclays Aggregate Bond Index down about 0.9%, and then the Dow Jones Industrial Average selling off the most, down about 2.7% on the week. Heading into our economic data, it was a slower week, so there's a little bit less to cover, but still some important stuff here. Then we'll also cover the upcoming events in the next 2 weeks because there's quite a lot. So first off, looking at leading indicators, the Conference Board's leading economic index and all of the components that made up the LEI here. The LEI declined about 0.5% in the month of September, so a modest decline there, continuing the decline of 2.6% over the past 6 months. This drop was primarily driven by weak new factory orders. You can see the ISM index of new orders, that was a negative contributor, as well as the interest rate spread, so the inverted yield curve, that continues to be a leading economic indicator that signals bearishness, followed by building permits, private housing, and consumer expectations for business conditions. On the positive side, though, we have the S&P 500 in September. That was a positive contributor, as well as initial claims, and the leading credit index also slightly positive. So overall, we are still in a downward trend in the LEI, but we have yet to see a recession. So leave some questions unanswered there, but we'll continue to monitor all of these leading indicators and continue to incorporate them in our view of markets. Moving along in our week, we got some important residential real estate data from existing home sales as well as new home sales. Existing home sales clocked in at 3.84 million in the month of September. This was down 1% from August and down 3.5% in the number of homes sold from a year ago. Inventory also ticked up to 4.3 months of inventory, so homes are moving slower than they did a year ago. And then last but not least, the median sales price is up a very moderate 3% compared to the 4, 5, 6% housing inflation that we've seen in previous months. And that leads the median sales price to $404,500 for the median home sold. So overall, we are still seeing some slowness in the residential housing sector. It'll be interesting to see how soon this could turn around with the Federal Reserve implementing rate cuts. This is just ahead of their late September rate cut, so it doesn't fully price in any of the immediate effects in the housing market. But mortgage rates and other interest rates are not always exactly correlated with what the Federal Reserve does. So the Fed can make changes in their short-term rate, but that may not impact mortgage rates for another 6 months, maybe even more, maybe less, as there are so many more dynamics that go into things like mortgage rates. Along with existing home sales data, we also got the new home sales data for the month of September, showing that new home sales volumes rose by 4.1% in the month of September to 738,000 new homes sold. Many builders offering new price incentives in an increasingly competitive market, trying to attract increasingly budget-conscious buyers. The median sales price for new homes sold in the month of September was 426,300, essentially flat from a year ago, while the average sales price declined by 2.7% annually to 501,000. So we're seeing either flat or declining sales prices in new builds. And you can see in this chart over here, we have been continuing to trend down. And now the question is whether the housing market is going to accelerate or continue to decelerate in the coming quarter. So we'll continue to watch out for the data on this. Moving along in our week, we also got the Chicago Fed's National Activity Index, which showed September as a bearish month, the index dropping to negative 0.28 from a previously more neutral level in August there. And the biggest cause of this indicator dropping to a bearish level was a huge drop in production and income, at least in this measure in the month of September. You can see that in the red bar there, that's contributing to the negative decline in the month. And this comes as one of our many indicators that we watch on a regular basis, signaling caution ahead for the US economy. So, again, one indicator is never a telltale sign of the economic direction that we're going in, but this one has been either neutral or bearish for quite some while here in 2024. So, important stuff as we continue to assess the economy. Last but not least, we are in the middle of third quarter earnings season. One of the most remarkable earnings stories of last week was Tesla. They reported a 24% beat on their bottom line, so came in much higher than expected on their earnings per share. And then Elon Musk also issued extremely bullish vehicle growth estimates for the next year. They expect vehicle growth to be in the range of 20 to 30% higher in 2025 than it was this year, and that's on the increase of lower cost Tesla sales as well as advancements in autonomy technology. So, very bullish earnings for Tesla last week, and in the next slide, we're just going to cover what we're looking at in the next 2 weeks. Finally, here, just taking a look at the upcoming 2 weeks because it is a very busy 2 weeks. You can see this week we're going to get consumer confidence, the first third quarter GDP estimate, PCE inflation, the October employment report. Then we're going to get the ISM indexes here as well. And then next week we have election day, so get out and vote by November 5th here, and a Federal Reserve meeting. So just many catalysts here in the coming 2 weeks that we want you to be aware of and that we will be watching closely to see how they might impact markets and portfolios. Thank you so much for tuning in to this week's market update, and we look forward to providing another update to you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.